Hello and welcome to our Fortune and Freedom budget response video. I've invited four of our editorial team to give their analysis on the budget, which has taken place yesterday. So we're recording on a Thursday. I've invited James Allen, John Butler, Kit Winder. Unfortunately, Sam couldn't make it. He's moving house, for those of you who are wondering. Let's start, everyone, with a sort of open round about what your big takeaway was or something specific that you might have noticed about the budget. John, why don't we start with you?
Well, what I would notice, first of all, is that this is a tax and spend budget, which everybody was expecting. There's no surprise there. What I found a little bit surprising, although I think there's an explanation for it, is that on the tax side, pretty much every group you can think of is going to get hit with new taxes here. That is, this is not just going after the wealthy. It's not just going after non-doms. It's not just going after, whatever group labor doesn't necessarily care for. It's kind of going after everybody, even the so-called working people that became a contentious phrase over the past couple of weeks. So that, I guess you could say, is a little bit surprising. Now, two things about that. First of all, Labor can still try and blame the need for this across the board set of tax increases on the prior government. So they're still going to they're using up the remaining political capital they might have thought they had by blaming the current situation and need to raise taxes across the board on the conservatives. And the second thing I mention is this. Notice that part of the spending increases that are occurring here are to fund large pay increases for public sector workers. So actually, the public sector workers aren't going to feel the pinch because to the extent they're paying a bit more in tax, they're simply receiving more in salary in the first place. And so it's really the private sector that is getting disproportionately hit by this, something which, given labor's, traditions and whatnot, perhaps shouldn't be all that surprising.
James, what was your big takeaway or something you particularly noticed?
Yeah, similar really. The first thing obviously was the some of the eye-watering numbers in both directions, both from sort of tax raises and also in investment. We've got £74 billion of spending by the end of the Parliament and £41 billion in tax rises. I think in terms of tax, that's as a percentage of GDP, these are the highest levels ever. I think this could also be the new normal, obviously. We've seen lots of reports now, not just in the UK, but across the Western world of declining birth rates. We have an aging population, a huge spend going into healthcare. So I think we better get used to sort of high taxes now for the foreseeable. I think that's just what we're going to see. In terms of my other big takeaway, really, is something actually they didn't talk about, and I'm going to bring up the B word, Brexit. In documents released alongside the budget, the OBR talked about the massive impact of Brexit on trade, talked about a 15% cut in UK trade over the long term, and presumably to reduce GDP by 4% over the long run as well. Yet, Reeves didn't mention Brexit whatsoever. It wasn't acknowledged that the Brexit, is costing the UK many billions of pounds a year, £40 billion a year, according to some estimates, and lost tax revenue with the EU. And I think there's a mistake. I think that's political dishonesty from Labour, really, not to acknowledge some of the costs of Brexit at a time when we are increasing taxes so much. So there'll be my two big takeaways.
And Kit, how about you?
Yeah, well, they've covered the big numbers very well. I was very curious in the run up at the sort of frenzied desire on so many people's part to panic about what the capital gains tax rise would mean and sell maybe some of their winners ahead of the budget in case they went up to 40%. And, in one way, that's a sort of reasonable response. Maybe their taxes were going to double. I think it was probably a little unlikely that they would have gone all the way to 40, and in the end, 24 is a sort of small, reasonable change. The first thing is that the government has managed to create enough fear that they have generated what will be a very large capital gains tax windfall from everyone panic selling before. What it really just reminded me about is the importance of compounding wealth over the long term and the relevance of tax to that calculation. Every time you sell a winning investment, you give a portion of it, as we know, you give a portion of your gains to the government. Now 24%, it was 20%. And that can have a big impact. So even if the rise in capital gains tax was 4% over a sort of 10 or 20-year period, the impact on an asset that's growing at 10% per year is actually between more like 8 to 10%. So factor taxes into your investment decision making. It's a reminder not to overtrade. It's a reminder to invest for the long term. It's a reminder not to interrupt the compounding process. So that was one of the things that I sort of found interesting.
Thanks, Kit. So for me, apart from getting a haircut that was very much inspired by the budget, what was especially noticeable was freezing those thresholds for inheritance tax and for income tax. That to me signals that the government is getting ready for a lot more inflation to come our way, which will benefit the HMRC tremendously if those thresholds are frozen. The share of people earning the highest share of income tax is rapidly rising. I think it's doubled in the last few decades. So I think it's 1 in 10 or 1 in 20 that the change. So I think they are preparing for a huge windfall on the back of inflation and on the back of what Kit just said with the capital gains tax. Of course, that's not adjusted for inflation. So you've got to remember, apart from the gains, you've also got to outpace inflation after paying taxes as well. And I think that's getting exceptionally difficult in a high inflation environment. Markets have not kept up with inflation adjusted for capital gains tax on that inflation. So it's been a painful period for investors. John, as the investment director, I want to ask you about this capital gains tax change. Do you think it's going to impact investors over the next few years in terms of the types of returns they actually try and go for? Are they going to become more income investing focused rather than capital gains?
Well, it does slightly narrow the gap, of course, between your expected after-tax returns, be they all coming from capital gains or be they coming from income. So yes, there could be a small shift there, but we're not talking about large enough numbers necessarily. The decision that institutional investors will make regarding whether to overweight income or overweight growth, which would be realized more likely through capital gains, has much more to do with the macroeconomic outlook more generally, rather than fiddling around with slight changes to the tax code. But there's a bigger issue here, which is that the fact is a capital gains tax is a tax on investment. It's a direct tax on investment. And you might say, oh no, it's simply a tax on realized wealth gains, but those came from investment. And if you tax investment more, you're going to get less investment. If you're going to get less investment, other factors equal, you're going to get less growth, in particular productivity growth, because productivity growth really only comes from corporate investment. There's nothing else in the economy that's really able to drive it as decisively. So it makes Britain, yet again, a less attractive place to invest. And that is very concerning because Britain does not exactly come high in the global rankings of where global investors want to invest. And so we're going to be stuck in stagnation if indeed the tax code continues to evolve in this direction under Labour.
Kit, it feels to me a lot like the rhetoric from the old austerity days with all of these taxes. The idea that we actually have to pay for the spending. And they're not using the word austerity, obviously. But do you think the political impact of having to raise all these taxes will be felt by the Labour Party in the next few months?
It's a very difficult question. I mean, the expectations management leading up to the budget was all around, realism, seriousness, and trying to pin as much as they possibly could on the last 14 years to enable them to get off to, I think, quite a harsh start. And I do expect them to slightly reset the narrative from now and start claiming wins and claiming victories for Labour and sort of separating what happens after the budget from everything that went before it. Austerity obviously is one of the least popular things that's happened in this country for a long time. And one of the big things we learned during the pandemic is how inflation is created. After 2008, central banks were printing money like crazy and everyone thought that would create inflation, but it was only in the pandemic when the government started spending that money that we realized or relearned that it's that combination of monetary stimulus, printing of money, and fiscal stimulus, spending it, that creates the inflation. So I think that's been the sort of big lesson of the last few years, and Labour are paying it reasonable heed, I think, not to let debt levels get out of hand, to keep a reasonable control of the balance of the budget even. Whereas in America, it's a completely different situation. Both sides completely happy to spend, no worries about the deficit's exploding. And, John mentioned the UK not being an attractive place to invest for very valid reasons. But if you compare our debt to GDP levels with America and their deficits going with it, gosh, it's a lot scarier over there, despite the incredible productivity and the incredible capital markets that they have. So there's no easy answers.
I guess the idea would be the US will at least continue to grow, depending on how the election comes up. But what you said about the Labour trying to front load all the bad news into this budget and therefore having a good run to the next election, that was exactly my thought too. The part where I disagree with you is if you look at the long-term projections, so the next 20 years, it's horrendous. No amount of tax increases could cover the parabolic rise for the reasons that James mentioned earlier with the demographic change. No tax increases could cover that parabolic rise in spending. So at some point, the exact opposite to what is in the news today will happen. At some point, someone will have to raise taxes even further, or there will have to be an actual drive towards austerity, which involves spending cuts as well. Do you think that's going to happen in the next 10 years, or do you think we're just going to go for broke, or perhaps just continue to increase taxes?
There is an element of a gamble to all this, which is that growth will save us. It's not quite to the same extent that Stephanie Kelton, this founder of modern monetary theory, believes, where you can have unlimited deficits and growth will bail you out. But that certainly is the question. We will need some productivity gains, some growth in order to start catching up with the deficits that we're building. And as John said, discouraging investment is maybe not the best way to do that, and discouraging wealth. But I think what we're seeing is the result of a very difficult situation, one that isn't as bad for us as it is in Europe, in France, in Germany, in Italy, and increasingly in America, despite its reserve currency status. So I think what we're seeing is something that we can actually expect to see more of spreading around the world, which is more discipline, more caution, more concern within the incredible constraints that we have built for ourselves.
Yeah, I'm not so sure it matters that we're not the worst. Perhaps it does for investors, but I think things are bad enough for the long-term projections that we're all in deep trouble, and only spending cuts will get us out, especially given the demographic challenge. I don't think growth is going to cut it, because growth in the past was a lot easier because of demographics. This time it's going to be a headwind, which means the productivity changes we would need are very, very large. James, let's move on to energy, which is very much your area of focus. You've in our preparation for this, you sort of mentioned there's a trade-off between the green world and the old gas and oil world. So where did the two sit as a result of this budget?
Well, funny enough, sort of shares across both of those sort of sectors, that they actually rose yesterday. So both were seemingly quite pleased. It seems like the oil and gas guys were sort of their shares rose more out of relief. Actually, that things could have been worse. I mean, and the green lobby, there's some quite nice bits and bobs in there as well. I was quite surprised they didn't sort of scrap the 14-year freeze on fuel duty. I think that was a big surprise, and I think obviously they're concerned about cost of living for people on that. But I think that could have been a sensible tax cut. I think could have worth 13 billion pounds. They extended and rose the tax windfall, the energy levy on oil and gas as well. It could have been worse. I think that's why we saw shares like Serica and Harbour Energy rise as well. So I think the oil and gas companies are breathing a small sigh of relief. In terms of the green side of things, I think there's some quite nice stuff in there for EVs. I think the rules, the changes in the fiscal rules to account for assets as well as liabilities, I think that could potentially unlock a lot of investment in green energy and green tech and infrastructure that's really needed to sort of make us catch up with what's been going on in the US, China, and in some parts of the EU as well. So there could be now big funding for gigafactories, EV factories, hydrogen plants, CCS. All those things could be coming down the pipe now, I think, with this some extra investment. So I think all in all, I think both sectors will be relatively okay. I think obviously I'd say the future probably is a bit brighter now for the green side of things, but oil and gas certainly could have been worse.
Sounds like quite a big change from the previous government. What about nuclear, which is a sector that I believe all of us are extremely optimistic about, especially Sam, who's not on the call, so I'm sure he'd want to hear about that.
Yeah, there was some comments from the Conservatives. There wasn't much going on in the budget with nuclear. I think Claire Coutinho said talked about the go slow and nuclear is confirmed. I'm not quite sure that's the case. There was no huge bells and whistles, but I think the budget provided £2.7 billion to continue Sizewell C nuclear plants. They talked about the start of contract negotiations with SMR developers and £430 million for nuclear fusion projects. The UK has actually doing very well in nuclear fusion as well. So that's not an insignificant amount of money. I mean, I think they could have done more. There's no real announcement about any big nuclear stations at all. But where we have come from, and the last 14 years of the governments, I think they built half of one reactor. So it's not all steam ahead, but I think there were some promising signs, I would say, for the nuclear sector. I think the SMR side of things is interesting. Particularly, we see some huge interest in that space already, dominated by the US. The UK is playing catch up. We have Rolls-Royce here, which is doing its best to get its SMR technology up and running. So I think all in all, nuclear will be reasonably pleased with what's happened. I think the UK has got some work to do in terms of nuclear for sure.
John, I asked you earlier about how the changes to capital gains tax might impact people's investment decisions. Sort of the same question about this inheritance tax and pensions being included in inheritance tax going forward. I'm going to write about this on Monday in Fortune and Freedom. It feels to me like a sort of Hotel California moment. You can check out anytime you like, but your money can't leave. Are you worried about this? Do you think this is going to change people's investment behavior? I mean, I find it a bit morally questionable, but what's the more sober and unbalanced take?
Well, it is something that people are going to have to come to terms with. That is, there are means of saving for retirement, and there are means of passing your wealth on to the next generation. And those two, they used to overlap quite cleanly, quite seamlessly, because what remained in a pension effectively would be passed along tax-free, almost like it was kind of a residual life insurance policy, right? So you could do your estate planning with some combination of life insurance and also your pension. That's going to have to change now. I suspect that that clever inheritance tax planning around how that is done will still be of tremendous use to wealthier households. I think, for example, the rate at which you draw down your pension, but then you continue to make life insurance contributions. There might be some sort of sleight of hand there that can be done to try to mitigate this, but it's a net negative. It is a net negative, and as you say, this sort of tax, that is a tax on what you're handing down to the next generation, is arguably a form of triple taxation, because you paid tax on your income, you paid tax on any wealth, any interest generated by your savings, and then in the end, what is left over following those two rounds of taxation, it gets taxed when you hand it to your heirs. So it's arguably a form of triple taxation, which I think many people would agree is indeed immoral.
Yeah, and if they spend it, they pay the VAT. Let's finish, John, on a mention of the bond market. I don't know what to make of the moves, because my understanding was the bond market was sanguine during the budget speech, and then supposedly someone crunched some numbers somewhere and bond yields rose quite a lot. So give us the narrative that explains that action.
Well, look, I mean, one can always try to guess what's going on here. The way you just described it, I think, is actually not a bad place to start. That is, some of the initial numbers that came out yesterday were, the order of magnitude that people were looking for. But then you look around at some of the details. And again, a lot of this spending increase is simply to fund higher salaries for public sector workers, something which, is not going to add to productivity or growth or anything. It's almost, I mean, this is being a little bit cynical here, but it's almost a giveaway to Labor's core base of support rather than anything that is truly good for the future health of the country. And so I think when you looked at the breakdown of where that additional spending is going, it's really going into something of a black hole from a growth and productivity point of view. Not all of it, but a large portion of it. The bond market's not going to like that, because what that means is that the revenue projections that come from the higher taxes are maybe not going to be as high, because the money that is being spent, the additional spending, isn't really pro-growth spending. So really, you could argue that the higher taxes are growth negative. The higher spending is not growth positive. The net result is the debt's going to rise faster than expected because the tax revenues won't grow as fast as expected, but the spending will definitely take place. This budget arguably accelerates Britain's arrival into a classic debt trap, where even if you're raising taxes, you're simply not able to squeeze out enough additional revenue because there's not enough growth to service the accumulated debt you already have to fund the spending you already made. That is where I think may have spooked the bond market slightly.
Well, everyone, we have some pretty deep ideological rifts between the four of us and Sam as well, but we've managed to keep it very civil, which is less likely to make this go viral. But what I find interesting about this is we can all agree there's one very obvious winner in all of this, someone we all love to hate, which is the financial advisor who's going to be getting all sorts of fees and commissions for having to rejig the entirety of everyone's retirement plans, especially on the back of this inheritance tax on pensions. It feels like the point of the budget is to give financial services firms a big boost every few years, which none of us are very happy about, given it's almost our job to try and get people to do this independently, and it's become just a marginal amount more difficult to do so each time all of these rules change. I think it's an important reminder of just how much the rules can change. So your long-term financial plans need to keep that in mind. I don't know. Maybe I should give one of our ideological enemies the last word here, John. Kit, do you want to react to anything John said there?
No, I always have great respect for everything that John says. I was curious though about just the idea of giving away the largest spending increases to public sector workers, and that therefore having a negligible impact on growth and spending. I think one of my understandings was that if the money is funneled towards those to whom it can make the greatest difference, it's more likely to get spent immediately in the real economy. Whereas if it goes into, for example, if they'd cut capital gains tax, that extra wealth sort of adds to a pile that already exists under the dragon's belly. And so actually I wouldn't be surprised to see most of that spending quite quickly turn into, I guess you would call it, just spending in the real economy. It will begin to flow through into goods and services in the UK, because that's sort of where the spending occurs at that level. So that would be my one very small question really to John, more than even a nuance.
Yeah, John.
Well, I mean, to reply to Kit ever so briefly, I was talking about investment as opposed to just consumption, right? That is, when you raise public sector workers' salaries, you're not doing anything to give businesses an incentive to invest. And that, to me, is the problem, that the growth simply won't be there. This is not pro-growth spending. It's pro-consumption spending, because it's not pro-investment spending. So yeah, as you say, you get a brief burst of growth from the consumption, but you don't get the longer-term investment that would be needed to generate the sustainable revenue growth to ultimately allow the UK to have a chance of growing its way out of the debt mess that it's already in.
Maybe this is one way of looking at that, which it's very much what's growing in Australia and partly in the US, where they're having GDP outperformance on the back of large public sector spending. That is not, however, investment in future productivity. So it's a trade-off between the future and the present. Anyway, let's leave it there before things get too academic. Everyone, thanks for coming in, and thanks for agreeing to do this budget response. I know it's not our biggest area of interest, but it does matter so much to our readers and viewers. in terms of their actual finances at the end of the day, after all of the taxes and fees and all the rest of it that gets taken out. To everyone at home, thanks very much for watching.